For decades, traditional financial gurus have force-fed us the same tired narrative, insisting that you must avoid debt at all costs, cut up your credit cards, and pay off your house as fast as humanly possible. They paint all borrowing as a suffocating burden that shackles your future, leaving you terrified of owing a single cent to anyone. But for a select group of audacious wealth builders, debt is not a trap. It is a powerful tool, a highly calibrated instrument used to acquire assets and scale ventures at a pace that pure saving could never match. If you are relentlessly focused on pinching pennies and dodging every loan, you are likely playing a game designed to keep you firmly in the middle class. The wealthiest individuals in the world do not get rich by saving their way to the top. They get rich by mastering financial leverage. We are uncovering the counterintuitive strategy of successful entrepreneurs who use borrowed capital to multiply their net worth, challenging conventional personal finance wisdom that keeps so many ambitious people playing small. To step into this arena, you must execute a fundamental psychological pivot and learn to brutally separate good debt from bad debt. Bad debt is the consumer trap you already know about. The high-interest credit cards used to buy depreciating liabilities like designer clothes, luxury cars, or expensive vacations. That kind of borrowing drains your cash flow and enriches the bank at your expense. Good debt, however, is capital you borrow to purchase an asset that puts money back into your pocket, ideally generating enough income to cover the loan payments and then some. When you take out a loan to buy a cash-flowing asset, you are effectively renting someone else's money to make a profit for yourself. According to research from the Federal Reserve, the strategic use of credit is a primary driver of wealth accumulation among the top 10% of households. This is the essence of financial leverage. You use a small amount of your own capital, combine it with a large amount of borrowed capital, and reap the returns on the total asset value. Real estate mortgages remain one of the most accessible forms of strategic borrowing available to the average investor. If you buy a $500,000 rental property in cash and it appreciates by 5%, you make $25,000, which is a solid 5% return on your money. But if you put down just $100,000 and borrow the rest, that same $25,000 appreciation represents a 25% return on your actual cash invested. That amplification of returns is exactly how everyday investors build multi-million-dollar real estate portfolios in a fraction of the time it would take to save up cash for every purchase. The mortgage allows you to control a massive, appreciating asset while keeping your own liquidity relatively intact. Meanwhile, the tenant's rent payments cover the mortgage, the property taxes, and the insurance, effectively meaning someone else is buying the asset for you over 30 years. The beauty of this arrangement deepens when you factor in the invisible wealth-building force of inflation. According to historical data from the Bureau of Labor Statistics, inflation consistently erodes the purchasing power of currency over time. When you hold a long-term fixed-rate mortgage, you're paying back yesterday's debt with tomorrow's cheaper dollars. The asset value rises with inflation. The rental income rises with inflation. But your debt obligation remains statically locked in place, shrinking in real economic terms every single year. Of course, leverage is a double-edged sword, and market downturns can quickly punish those who overextend themselves without adequate cash reserves. If property values plummet and rental income dries up, that fixed debt obligation suddenly feels incredibly heavy. The investors who lost everything during the 2008 financial crisis were often those who ignored cash flow, speculating on infinite appreciation with variable rate loans they could not actually afford. That historical lesson forces a rigorous discipline upon modern wealth builders. We do not use leverage to speculate. We use it to accelerate highly calculated, cash-flowing acquisitions. You mitigate the downside risk by ensuring your debt service coverage ratio is rock solid, meaning the income generated by the asset vastly exceeds the cost of the loan. When the math works, the debt becomes a protective moat rather than a vulnerability. Once you master this concept in the property market, the transition to scaling active ventures becomes the next logical frontier. Business loans operate on the exact same principle of leverage, but instead of buying a static building, you're injecting rocket fuel into a dynamic enterprise. Bootstrapping a business with only your own profits is honorable, but it is often painfully slow, leaving you vulnerable to better-funded competitors who can capture market share while you're still saving for your next marketing campaign. Imagine you run an e-commerce brand that has dialed in its customer acquisition cost, reliably turning $1 of advertising into $3 of profit. If you rely solely on reinvesting your organic cash flow, your growth is strictly capped by your current bank balance. But if you secure a strategic business credit line at an 8% annual interest rate, you can immediately pump hundreds of thousands of dollars into that proven acquisition engine. The cost of that capital is entirely negligible compared to the massive influx of revenue it generates. A study by the Small Business Administration highlights that firms utilizing external financing grow at significantly faster rates than those relying entirely on internal funds. You're buying time, compressing a decade of organic growth into a single aggressive year of expansion. The loan is not a burden, it is the exact mechanism that unlocks your fortune. This requires abandoning the employee mindset, which views debt as a monthly penalty, and adopting the executive mindset, which views debt as a cost of goods sold. When you take out a loan to buy new manufacturing equipment, open a second retail location, or hire a top-tier sales team, you are purchasing future capacity. You're betting that the return on those investments will far outpace the interest rate attached to the borrowed funds. Many people are terrified of signing a personal guarantee for a business loan, paralyzed by the fear of failure. But you have to ask yourself what the opportunity cost of playing it completely safe really is. If you refuse to leverage other people's money, you're implicitly choosing to leverage your own finite time and energy instead, guaranteeing a much slower, much harder path to financial independence. The wealthiest families in history, from early industrialists to modern tech billionaires, did not hoard cash in checking accounts to build their empires. They understood that cash is actually a depreciating asset, constantly losing value to inflation, while debt, when attached to productive assets, is a wealth multiplier. They used the banking system exactly as it was designed to be used, as a utility to facilitate massive economic expansion. Understanding this distinction fundamentally redefines risk and opportunity. The real risk is not taking on debt. The real risk is remaining financially illiterate in a system that heavily rewards strategic borrowers. When you know how to underwrite a deal, analyze cash flow, and stress test your worst-case scenarios, borrowing money becomes a mathematical formula rather than an emotional gamble. You begin to see the world through the lens of capital efficiency. Why would you tie up 100% of your own cash in a single business venture when you could use 20%, borrow the rest, and deploy your remaining capital into 4 other ventures? Diversification and scale are both achieved through the intelligent application of leverage, allowing you to control a vast empire of assets with a relatively small equity base. This strategy also unlocks incredible tax advantages that pure savers simply cannot access. In many jurisdictions, the interest paid on business loans and investment property mortgages is entirely tax-deductible. According to analysis by the Tax Foundation, the ability to deduct interest expenses significantly lowers the effective cost of borrowing, making leverage an even more attractive proposition for savvy entrepreneurs looking to optimize their net returns. Furthermore, borrowing against your assets is a primary strategy the ultra-rich use to fund their lifestyles without triggering massive tax bills. If you sell a highly appreciated asset to get cash, you trigger capital gains taxes, which can instantly wipe out 20% or more of your wealth. But if you take out a portfolio loan against that asset, you get the cash you need completely tax-free because debt is not considered taxable income. A critical macroeconomic reality underpins this entire strategy. The entire global financial system is built on credit and leverage, from corporate bond markets to municipal infrastructure projects. When credit markets freeze, as they did temporarily in 2020, the entire economy grinds to a halt, prompting central banks to slash interest rates to encourage borrowing once again. Recognizing this systemic reliance on credit means you stop fighting the current and start swimming with it. You align your personal wealth strategy with the fundamental mechanics of the global economy. Instead of trying to outsave a system designed to devalue savings, you become an allocator of capital, using the banking sector's infinite supply of fiat currency to acquire scarce, tangible assets that hold true value. This is where you must actively build your financial reputation. Your FICO score, your business credit profile, and your relationships with regional banks are just as important as your stock portfolio. These are the keys to accessing cheap capital. You cultivate a pristine borrowing history, not so you can buy a nicer television, but so you can command millions of dollars in commercial real estate loans when the right deal crosses your desk. Building this relationship with capital requires immense discipline. You must maintain strict accounting, present clear business plans, and demonstrate a track record of executing on your promises. Banks are eager to lend money to people who do not actually need it to survive, but rather need it to multiply their existing success. You position yourself as a partner to the lender, offering them a safe yield while you capture the outsized upside. As your portfolio of leveraged assets grows, a profound shift occurs in your financial velocity. The cash flow from your first leveraged property or business funds, the down payment for the second, which then funds the third and fourth. This compounding effect of leveraged growth creates a snowball of wealth that eventually becomes entirely self-sustaining, detaching your income from your daily labor. The fear of debt is a conditioned response, deeply ingrained by a society that wants you to remain a compliant, risk-averse worker. But you're stepping out of that paradigm. You now recognize that while consumer debt is the quickest path to poverty, strategic leverage is the ultimate catalyst for fortune. You're no longer intimidated by the zeros on a loan document because you understand the mathematics of return on investment. Building wealth with attitude means rejecting the limitations imposed by conventional advice and embracing the sophisticated tools used by the financial elite. Whether you're scaling a disruptive startup with business loans or assembling a real estate empire with smart mortgages, you are taking command of your financial destiny. Master the art of leverage, respect the risks, and use the world's capital to build an unstoppable fortune.